Today is July 8th, 2026. Markets are reacting to renewed tensions across the Strait of Hormuz between the US and Iran, which lifted crude oil prices today by over 8%, and of course, feeding into the strength of the US dollar index against the markets. Mainly major currencies are still under stress against dollar strength, and we also have stress against precious metals, gold and silver, that are still trading near vulnerable levels that may open the path to fresh 2026 lows for a long-term accumulation opportunity may come into the light. We also have pressure and risk-off sentiment facing US indices, and notably Nasdaq, as we have rotation out of tech and AI sectors and more towards cyclicals, which is keeping the Dow Jones on a bullish front end. However, the US Iran tensions cap the overall picture ahead of next week's start for earnings season that may also bring fresh volatility risks to the markets and notably US indices and risk assets. These are the main themes to watch for today. The setups are still, and the key levels that we were mentioning are still holding, notably with the strength of the US dollar index. So, starting with the DXY, from a monthly time frame perspective, we're still holding or testing a potential breakout beyond the bounds of a respected support and resistance since 2023. That is likely to be confirmed with a close above the 102 mark. Close above 102 would likely increase bullish expectations towards the upper end that respected downtrending channel since 2022. I'm already going over the scenario in the webinars. You can watch the full scenario of the DXY in my previous webinars. From a long-term perspective, we're watching that multi-year previous support turn into a resistance to confirm a potential steep bullish breakout that may pressure major currencies, especially currencies like the yen, into multi-decade, the dollar yen pair into multi-decade highs, and of course the euro and the pound towards major lows before another potential long-term accumulation opportunity. From the downside, at least short-term levels to be watching would be the 160 to the 130 level, aligning with the trend line, connecting consecutive higher lows since May 2026. Stay hold below that may expose the 99.30, connecting consecutive higher lows across 2026 that may keep the bullish bias intact unless we have a sustained hold below that level that may put the pressure once again on US dollar index. However, given the overall tensions that we're currently seeing in the markets with a higher for longer interest rate environment, the bullish structure is expected to remain, especially against the euro, which is still facing pressure below the 1470 mark and the 1430 level. Now, overall, as previously mentioned, the euro is also near a critical and respected level. A previous resistance turned into a support, which is above the 1280 to the 13 mark, and the sustained hold for the euro below that level, in line with monthly RSI dropping below the 50 neutral mark, would open the path for further weakness, possibly aligning with the upper bound of the 2008-2025 descending channel near the 110 mark for potential long-term accumulation opportunity on the euro once again. If not, if we close below the 110 mark, we can be facing extended consolidation risks back within the dominance of that descending framework once again. On the upside, we're going to need to clear the 1470 and the 1660 marks to be able to start building that confidence towards a bullish rebound on the euro. Okay. Now, for the main chart driver, as a result of renewed tensions between the US and Iran, revoking Iran's oil sales license, and also with fresh maritime targets across the strait, lifting security risk across the Strait of Hormuz. Once again, we had the bullish rebound for crude oil prices that was already colliding with daily oversold momentum that we were previously mentioning, aligning with lows last seen in 2025, in line with crude oil's overall alignment with a well respected zone that previously acted as a resistance, turned into a support. At least since 2019 on the chart, which is near the 6650 zone, where crude oil prices last recently touched. Now, if you look at the broader picture for crude oil prices, we may still be facing oversupply risks towards the year end as we have higher OPEC plus production quotas and recovering Gulf exports overall, which possibly puts the overall bullish rebound into a short term framework unless key resistance levels are claimed. So from the upside over here, taking the Fibonacci retracement of the decline between June 4 and July 1st, we can see that the first resistance here is near the 27.2%, near the 74.80 to the 75 mark on the WTI. Sustained hold above the 75 mark would likely extend bullish forecast towards the next key level for another potential pullback risk near the 78 mark, as it aligns with the resistance of June 22 and the support in April 17, where we had a major rejection, not just in April but also in March 2026 for another potential high probability pullback risk. If not, if we have a sustained hold above 78 as well, we can boost the bullish rebound expectation towards 81.40 and the 84.70 to the 85 mark, aligning with the golden 618 for another potential high probability setup for a pullback risk before making any further assumptions to the upside, which would likely be accompanied by another major supply disruption across a global crude oil markets. On the downside, as I previously mentioned, should we have a sustained hold back below the 71 mark and then further back below the 69 zone, we can possibly target the 66.50 again for either another bullish rebound or extended drawdown risks targeting also a previous respected resistance turned into a support between 2025 and 2026 near the 61.80 mark, and a sustained hold below that would likely target the lows connecting at 2025 and 2026 near the $55 mark for a potential extended consolidation risk on the crude oil chart. Once again, also potentially reaching the full target of that bearish breakdown below that consolidation between March and June 2026. Next up, we have the gold chart, also still respecting, apologies for the Fibonacci, also still respecting the outlook that we had with overall bearish dominance as gold prices were still fluctuating below the bounds of a descending resistance connecting lower highs since March 2026. Despite the latest rebound that we saw back towards the 4,200, we were still in relatively bearish zone for both gold and silver, in line with daily momentum still capped below the 50 neutral mark, which did not give any long-term bullish confirmation for gold rebound. And given the latest drawdown over here, we're currently facing potential support near the 4,030 to 4,020 zone. Sustained hold below the 4,020 would likely target once again 3,960 to the 3,930 for either another bullish rebound or extended drawdown risks, as I previously mentioned on the 6-month time frame. Now we may have potential short-term support near October 2025 lows and near the 3,880 mark, but the longer-term setup may be hinting towards a much deeper correction in line with that 6-month shooting star reversal candle and breakdown below the 27.2% of the all-time low and high on the gold chart, potentially targeting next at 3,400, 3,420 to the 3,500 zone if we modify these levels on the daily time frame as they align with a multi-month resistance respected across 2025 for potential high probability setup for dip buying opportunities on gold before making any further assumptions for further drawdowns. On the upside, of course, we still there's lots of appetite in line with the recent weakness seen on gold and silver to reload long-term bullish positions. On the upside, I'm going to be looking at 4,220 and the 4,280 as a first potential confidence indicator for a potential bullish shift, and the sustained hold above that key area over here, above the 4,370 to 4,440, would likely confirm or increase the confidence for a solid bullish reversal on the gold chart that may direct back towards the 5,000 mark and new records. That's for the gold chart. For the silver, we're also facing quite similar scenarios. Sustained hold for silver back below that gray area, so that back below the 56 mark to the $55 zone would likely target next the 53.50 mark, followed by the 49 zone and the 46 level. The importance of this level also stems from the all-time low and high of the silver chart, where it aligns with the golden 618 of that overall trends retracement for high probability setup for a rebound or dip buying opportunity on the silver chart, also aligning with a multi-decade resistance connecting consecutive weeks between 1980 and 2011. On the upside, I'm going to drop down to the daily time frame. We also need to clear uh, price action above the bounds of that descending resistance connecting consecutive lower highs since June 2026. So the first key area to be looking at for the silver chart would be the 64 to the 65 zone over here. Sustained hold 64.50 to be exact. Sustained hold above this level would likely target the 68 mark first, followed by the 72 level for high probability setup, either for a pullback risk or confirming a bullish shift on the chart, increasing confidence back towards triple digits on the silver chart. Look at it from a momentum perspective, it seems like we had a head and shoulders pattern breakdown, and we're still fluctuating below the bounds of its neckline. And should we have the momentum target the full potential of that pattern, we may be aligning with daily oversold conditions last seen in 2020, forcing a major reversal on the silver chart. That's for silver. In terms of Nasdaq, we're still fluctuating within the same bounds that we mentioned yesterday. Actually, we broke down below the lower bound, yet we're still eyeing a critical support zone here near the 28,600 and 28,800. Sustained hold below 28.6 would likely reinforce selling pressure on the Nasdaq chart, possibly targeting 27.7 and 26.7, aligning with key Fibonacci retracement levels also mentioned in the previous webinar. That's the harmonic pattern. Aligning it with the advance between March and June 2026, the first target would be the 27.7 near the 38.2%, next one near the 50% near the 26.7 for potential dip buying opportunities on the Nasdaq that may be aligned with the earnings season. We can also see a similar consolidation on the momentum chart, and should we have that very scenario develop, we can possibly see daily momentum aligning with oversold levels last seen in 2026 for also potentially supporting dip buying opportunities on the Nasdaq chart once again. On the upside, we're going to need to clear out or reclaim back the bounds of that consolidation, so back above the 29,300, and of course key levels on the upside to watch are 29.8, the 30,100, and the key area here, which is near the 30,300 and 30,600, taking it level by level, as when we're entering a consolidation, we tend to have a ranging bound for the Nasdaq that will be confirmed after a sustained hold above 30,600 for a potential directional, a bullish directional rally over 1,000 points, possibly targeting the 31,400, 31.9, and 32.4 at least before another meaningful pullback emerges on the chart. With respect to the Bitcoin chart, we're also facing a similar scenario that I mentioned in the previous webinar. Key supports are the 62K and then the 60,900 to 61,000 mark. Sustained hold below that would open the path or expose the yearly lows before building confidence towards fresh 2026 lows that may target August 2024 lows near the 49.9 to the 50,000 psychological mark for another major bullish opportunity emerges on the Bitcoin chart. On the upside, I'll be watching the 64,000 and 67,000 to be able to build confidence back towards a bullish outlook on the Bitcoin chart. The outlook is still holding with price action still attempting to hold the lower bound of a respected uptrending channel since the lows of 2023, which is still keeping the outlook in a resilient to bullish outlook on that overall uptrend. And we're going to need to have a sustained hold for the price action, as I previously mentioned, above the 19.6, the 20 mark, and the 2040 to be able to extend long-term bullish forecasts on the chart in line with the suspected uptrending channel. On the downside, I'd be cautious about that previous support area here, the 1890, and of course 1830 before making any further weakness assumptions on this chart. Last but not least, the favored Salik is also bouncing off the upper bound of that consolidation between April and June 2026. We can still see some resilience over here. We broke below that extended consolidation that we were analyzing here across the month of June 2026. We also have daily momentum drop below the 50 neutral mark. Approach it more from a daily perspective, we can see oversold conditions here. And price action had managed to come close to that previously highlighted support near the 5.6 mark. We did manage to go to 5.63, where we're seeing a hold or attempted hold for the price action. Climbing back above the 5.8 mark would reinforce the bullish outlook back towards 6.13 before extending bullish outlook towards 7 and 8. On the downside, breaking down below the 5.6 would likely target 5.4, aligning with the bottom bound that we expected uptrending parallel channel since 2022 for another potential dip buying opportunity on the Salik chart. I'm covering these charts almost every day on the Daily MENA Market Call. Feel free to watch the recording of these calls on our Forex Middle East YouTube page. Happy to cover any chart that you would like. Feel free to drop those in the chat box or in the comments on YouTube, and we'll see you in the next webinar.